Real estate investment practice problem using Excel. Home buy versus rent calculation part number 2. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we have 3 tabs down below: example, practice, and blank. Let's take a look at them now, starting with the example tab, in essence being an answer key. Information's on the left-hand side, assumptions that we're going to be making when we do our comparison between a home purchase and the renting situation. Once you have things set up in the Excel worksheet, you can then change your assumptions on the left-hand side and run different scenarios. In a prior presentation, we used that information to calculate the payments, to create the amortization table. We used that then to make a pivot table, which breaks the information down on a year-by-year basis. We then copied the pivot table into another table just to duplicate it so we have something that we can refer back to easily with cell references. Now we're going to be focusing in on the home purchase side of things, it generally being more complex than the renting side of things. Looking at the property value, we assumed, you'll recall, that it's going to be increasing at basically 2%, although we have to also think shortly about whether or not we're going to realize that increase and what will be the cost of that. We'll think about the cash flow related to the home purchase before taking into consideration taxes or the impact of the taxes on things like interest. Then we'll think about the tax implications on things like property tax and interest. Then we'll take a look at basically the cash flow after taxes, comparing it finally to the renting, which will be nice and easy for us. Will just be the rent calculation and so on. And then we can take the difference between those two. Okay, that seems overwhelming, but not too bad. We're going to go to the practice tab. This tab has some pre-formatted cells that you can work in the practice problem with a little less formatting calculations. The third tab is going to be the blank tab. That's where we're working. So here's where we left off: amortization table, the pivot table summary. All right, now we're going to estimate the property value. We're going to assume the property value is going up. This is going to be necessary because it could have an impact on our property taxes, for example. So we got to know what the property appraisal value is, even if we're not, in essence, selling it. So I'm going to say, all right, let's calculate the property value over time. Obviously, after the sales point, we don't know exactly what it is. We're estimating the property value. We're assuming it's going to go up by 2% at this starting point here. So it's going to increase by 2%. Going to do our formatting, font group, making this black and white for the formatting. Going to add our years, which is going to be 1, 2, 3, just pulling that on down to 30, bringing that on down to the 30 years. We'll take that out to 30, centering that. And then the value started off at the cost, which is equal not to the loan amount, but to the cost, which was way over to the left, $750,000. Now we're going to be pulling this data from the information all the way to the left oftentimes. A lot of scrolling involved. Note that you could hide cells up top if you want to get like right next to the data that you're working with. We might try that in a little bit later, but I'm just going to do some scrolling here for the time being. We're going to say that it's going to increase by, I believe it was 2%. That's our assumption. The property value going to go up by 2%. That might be due to inflation, or it might be due to our estimate on what we think is going to happen with the property values, in essence, over time. So I'm going to say this equals the prior amount, the 750, times, scrolling all the way to the left to our data, we said that it's going to have property growth of that 2%. I'm going to make that an absolute reference because this is outside of my data set and I don't want that cell to move down as I copy it down. F4 on the keyboard, therefore, we got a $sign before the B and the 5 and enter. Then we can well, hold on a second. That's not right. Let's do that one more time. That would increase it by the 2%. And we need to make it go up by the 750 plus the 15,000 to the 765. So I'm going to do that by saying this is going to be equal to, let's put brackets around this, 1 plus the 2% or 102%, and then enter. So now we're at the 765. So in other words, once again, we took the cell above it times the 2% plus 1, or 100%, in essence, 102%, or 1.02. And there we have it. We could then copy that down. So we think the value is going to be increasing as we go by that 2% increase. Let's widen the cell a little bit so it can fit all the numbers. And there we have it. So there's our values there. So that's going to be the value of the property on a year-by-year basis, assuming it goes up 2% over time. Next, we're going to be thinking about the cash flow before taxes. So we're going to say, let's call it this. Let's call it cash. Let's say home cash flow before taxes, BT. Now, this is one of the limitations of doing this kind of vertical formatting instead of like a horizontal, which we might do later, is you kind of have to squish this stuff up into the columns instead of the rows so that I can have the years on a column by column format, which could lead to more abbreviations and so on. But in any case, I'm going to center this. Let's wrap the text. Let's center it. Let's make it black and white. And then I'm going to just put my years here again, which is going to be 0, 1, 2. We'll take those three. We'll bring in that all the way down to 30 years. 30 years, centering it. So there we have it. So there's going to be that. And then the cash flows are going to be related to property taxes. Now this, we're focusing in, of course, on the home rather than renting, because renting is pretty straightforward. We don't have property tax. We don't have insurance. We don't have maintenance, because they're hopefully the landlord's going to do that stuff for us. So then we have insurance. Then we have let's just call it maintenance and period. And then we have the loan payments that we're going to have to make. And that's the total. So here's like the cash flow over time. Obviously, we got to think about the cash flow. And then we got to think about the tax implications. And then we got to think about the equity in the home and what would be the case if we were to realize that equity, in essence, selling the home. And so let's go to the home tab, format paint this thing. Format paint this across. So we got our headers there. It's all centered. Let's make this one a little wider. So that looks good. Okay, so property taxes. So obviously we got nothing at period 0 up top for these items. But property taxes, we're going to say this is going to be equal to the property value, which we're going to say is, let's say the prior year property value is going to be used in order to assess the property taxes times, I'm going to put my cursor back down, going all the way to the left, and say the property taxes is typically on the value of the home. We're going to say they're at 1.5%. That could differ depending on where you are at. I'm going to say F4 on the keyboard, $ before the B and the 10. So then it's going to be 11,250. We're going to say for year one. I'm going to copy that down, and it always takes the prior year to calculate the property tax. So it may not be the case that property taxes will go up each year. It may not be the case that the place that you are at are going to reassess the value of your property each year, but it kind of depends on the location you're at, and they could, right? They could basically say, we think the value of the houses are up, and depending on the laws and whatnot, it's usually based on the property value. And if they say your property value is higher for property taxes, that's usually bad, because then they want to take more of your money. So then we've got the insurance. We're going to say the insurance, we're saying it started at a cost, we say at the 700. That's going to be our starting cost. We're going to say that the insurance is going to go up by inflation, which we're assuming to be that 2%. So the costs, general expenses will typically be going up by that 2%. So I'm going to say the 700 times. Scrolling back over here, we're going to pick up the insurance and say it's going to go up by the expense growth of 2%. We used, in essence, the growth of 2% across the board. They don't have to be the same. It might not be all the same because of inflation, but we're going to use basically the same number for the growth rates across the board, in essence, saying it's due to inflation. So that's going to be $ before the B and the 4, making it absolute. Copying that down. Now, I did the same thing again. I want it to not be 14. I want it to be 700 plus 14. So I got to say it's going to increase by 100 plus the 2%, or the 102. So I'm going to double click on this, go back in here and say it's got to be times brackets 1 plus B8, or the 2%, closing the brackets. So it's times 102%, or 1.02. That's the number we're looking for, 714. Copying that down. There, that is maintenance. Same kind of thing. We're going to assume maintenance costs. We're going to have to pay the maintenance people. If we rent 800, we're going to say, obviously, if we're renting, if we're owning, we got to pay for the maintenance. If we're renting, we just call the landlord and say, would you fix this thing, please? So it's going to increase by, once again, 1 plus the 2%. 2%. Maybe too lazy even to do that. It's like, I've got to wait for you to fix something. It's ridiculous. I don't even want it. So you get kind of spoiled, So anyway, we're going to say 1 plus the 2%. We're going to say that's going to be equal to, now I messed it up. I was talking. Oh, I'd missed the multiplication times. Need the multiplication sign there. So we got the prior thing times 1 plus the 2% or 102% or 1.02, copying then that down. So there we have that. Then we have the loan payments. So from a cash flow standpoint, we're going to have to be paying, of course, the loan payments. So this is going to include both the interest and the penalty and interest penalties, the interest and the principal amount. Let's pull this on over from our table here. Now, this is the area where I could pull it from the pivot table, but I would rather pull it from this other table that I'm pulling from the pivot table in the event or in case I do something to the pivot table other than just make it my 30-year summary, which if you're not going to do that, you might be able to pull it from the pivot table and not have a problem with it. But that's why I did that second step here. So we're going to copy that down. That's going to be the same all the way down, although the breakout between interest and principal will differ, which will have an impact on the ending loan balance. But we're talking here about cash flow. So we're talking payments, which are the same. So let's sum this up then. We're going to equal the SUM of these cash flows without considering taxes. And we'll just copy that down. Let's put a total on this one. This one needs a total column, I think. Total this one for the whole lifetime. Total, sum it up. Totally needs a total column or row. And then we'll copy that across, copying that across. And we'll make these two a little bit larger so we can see the number, because it's not, that's why we're doing it. If I can't see the number, what's the point, right? What's the point? So then let's think about our taxes, tax implications then here. So now we're going to say, well, I'm going to get a tax benefit from this, and that's going to improve my cash flow. That's what they keep telling me. So let's pick up the cash tax benefit. So we're going to say cash flow for tax deduction, cash flow tax savings, let's call it. See if I can wrap that without it getting too messed up. Let's try to go over here and do the format painter. Format painter, there we have it. We'll bring this on down from 0, 1, 2 once again, down to 30 years, looking at it on a year-by-year basis, down to 30, center it. All right, so now we got our taxes. So we're going to say the things that are deductible are the property taxes, so I can pull that out basically directly. I'm just going to say property taxes, and then the interest. I'm going to type in interest is deductible, not the total payment here, but just the interest, because we're looking at taxes. So let's then go over here. We're going to say let's center that, or let's just do our format painter. Clipboard, format paint these two. Now this gets a little, if these items are significant to your calculations, you want to put a little bit more time into them, because if you're renting, you're probably not itemizing, and therefore you're taking the standard deduction, and you really want to look at the gap between the itemized deductions and the standard deductions, because you need to take that into consideration for your differential benefit between the standard and itemized deductions. In other words, if I was just taking a look at these property taxes, and if I didn't have the property taxes, possibly I would be taking a standard deduction. But then if I get to deduct these property taxes, then maybe I get to go up towards the itemized deduction items. But even if I get the full $11,250 of the property taxes, which it could be capped and whatnot due to the height of the property taxes, but even if I get the full amount of the property taxes, then I really need to look at what the difference was between the standard deduction and the itemized deductions to see what that benefit would be. So you want to put a little bit more thought into these. Also, the property taxes could be capped. They could change the laws in terms of how much state and local taxes that you can have, and so on and so forth. So you got to take that into consideration as well. And so these two, you want to put a little bit more thought. You can do that with tax software, so you really kind of need the tax software to get the idea of what your actual benefit would be, the difference between if you're renting, probably not itemizing, and then itemizing, and then you looking into any caps that might be involved with like property tax. Let's assume that it's going to be capped at the 10,000. Again, the tax law could adjust these property taxes, but we'll add a little level of complexity and say that we're only going to get, up to 10,000 of a benefit, which is still, you also have to combine that property tax, state, local, to possible income taxes you might have as well to see if those are going to skew the cap that you might have for state and local taxes. But let's assume that we got a cap, so we can put a fancy formula in here on the property taxes to say that it'll cap at the 10,000. So I'm going to do an if formula. This is going to be equal to if, and then brackets. We're going to say this number over here, the property taxes, if that is less than 10,000, then, which is a comma, then I want you to take that number. But, which is another comma, if it's greater than 10,000, we want you to take then the 10,000. So we're going to cap it at 10,000, assuming that's going to be our cap on the property taxes. Again, you got to take into consideration the current tax laws on here, which projections help out with. So we'll cap that out at 10,000. And then the interest, let's say the interest is going to be equal to, we're going to pick up the interest over here on the loan amount. So that's going to be the sum of the interest. So not the full payments, but just the interest portion. Enter that. We'll take the full amount there. Copying that down. So there's going to be our tax benefits. Let's add those up. We're going to call this a subtotal. And we'll add that up. And let's format paint this one over. I'm going to format paint 2 ones over. And this is going to be cash flow from the tax savings, the total on this side. So we're going to say, all right, the summing of these up equals the SUM of these two items. Those are going to be used to calculate our tax savings. And then I'm going to multiply that amount that we're going to say is going to be the deduction amount by the highest tax rate, by our marginal tax rate. That's going to be the general idea of it as well, because it's the change on the margin. So I'm going to say this is going to be this 51,807 times. I'm going to scroll all the way to our data on the left side and say that we're at the marginal tax rate, our top tax rate, at 25. Now, this being significant, it could have an impact on multiple brackets, so you could get into more detail on this tax implications as well and use actual projections on it and whatnot, but using tax software. But I'm going to do this here. F4 on the keyboard, $ before the B and the 9, making that second one absolute. So we're going to say the tax impact would be the 12,952. Copying that down. So there's our tax impact. So now we could say, okay, so the cash flow after taxes then is going to be our cash flow before taxes, plus we got this tax benefit that we're assuming we're going to kind of get back when we do our tax return due to the benefits of owning the home, the deductions of the interest and the property taxes. So we're going to say cash flow after taxes. That's what that AT means. And let's go ahead and format this. Let's make it black and white. I'm going to once again label this at 1, 2, 3. Copying that down. Let's say 0, 1, 2 to be consistent here. Copying that down. And so we're going to center that. And then I'm just going to take the difference between these two items. So it's going to be equal to, this is my cash flow before taxes. And then we're going to say that we got a tax benefit when we do our taxes of the 12 minus the 12,952 that we're benefiting. So our net cash flow then 47,700. So 47,700, copying that down. So there's basically our cash flow from the purchasing side of things. Now let's think about our cash flow from the renting side of things to just compare that. Renting being nice and easy, cash flow for the rent. If I was renting, bracketing this, black and white. You might even make the renting like a different color just slightly so you can say it's, the renting versus the purchasing maybe. And we're going to say this is going to then be 0, 1, 2. Copying this down. Copy this down to 30 payments. centering that. So the renting is going to be straightforward. It's just going to be, we said, equal to all the way to the left. We said the rent just cost $24,000. Straightforward. And then I'm going to say enter. It's going to go up. We're going to assume by that inflation rate, the 2% a year equals the 24,000 times, let's do this right the first time, this time 1 plus times 1 brackets 1 plus the 2% or 102% increasing rent. We're going to say year over year due to inflation. This is outside our table, so we need to make it absolute. F4 in the keyboard, $ before the B and the 4, closing it up and enter. So the rent's going to go up in year 2, we assume, to $24,480. Copying that down. So there we have that. And then we can do our comparisons of the cash flows. This would be the cash outflow if we were to be renting. This is going to basically be the cash outflow if we were to be purchasing. So we're going to look at this from the standpoint of purchasing, making the investment on the purchase. So there'd be a net, if we purchased, there'd be a net decrease in the cash flow, the difference between these two. So I'm going to make it a negative number. But we, of course, would have the value of the property increasing as well. So it looks like the cash flow in this scenario, the way we set it up, is going to be a lot higher with regards to the purchase. But, and that could be, we might be comparing different size, whatever. But there's also going to be the increase in the value of the property in the equity if we were to sell the property. So, which you have to take into consideration whether or not you can access that cash flow and Anyway, so we're going to go and then take the difference. So the difference in the cash flow. So we're going to say cash flow, let's say like rent minus purchase. Rent minus purchase. Let's select these two this time. I'm going to right click this time and format this a little bit differently. Formatting the cells. Go to the alignment. And I'm going to go to a horizontal alignment. I'd like to center this across the selection so that I could center it across those two. And then I could wrap the text here so that it wraps across those two cells right there without having to merge the cells, which I don't typically like to do. We could then right align it too if we want it. Now let's center it across. Center across. Okay. So then this is going to be then 1, 2. Let's copy this down to 30. Hold on a second. This should be 0, 1, 2. Copying that down. Copying that down. So there we have it. All right. And then we're going to center this. And this is going to be like a combo. Let's make this a different color to try to. Let's make this like this dark brown, and I'll make the letters white. And so this is going to be the difference between the two. So I'm going to take the renting minus the purchase cash flow. And so the difference is 23.7, copying that down. So we could see this as a difference in the cash flows. So now once we have that, then we'd kind of like to take into consideration what would be the benefit of selling the property if we were to sell it at 1, 2, 3, 4 years. So we can take into consideration the equity on the sales side, which we'll do next time. And then we'll try to figure that out and have a nice fancy table to kind of figure out the cash flow and the internal rate of return if we were to invest in the purchase versus renting, taking into consideration the differences and the cash flows. So we'll continue on with that, possibly finishing it up hopefully next time.